In Q3 2025, Chinese billionaires made a move so quiet that 99% of investors missed it. They siphoned $47 billion out of US stocks and converted it straight into physical gold stored offshore. No tech stocks, no real estate, no crypto, just enormous metal. Heavy, silent, untraceable. If this feels familiar, it should, because this is exactly what happened in wealthiest 2007. Months before the global financial crisis detonated. Back then, the exodus from US assets was the first domino. Then came the 57% market crash. Then came Lehman. Then came the loss of $8 trillion in American wealth. And it all started with the same quiet, calculated move we are seeing again right now. Here's the proof. Let me break it down. This is concrete data from official sources. In the third quarter of 2025, July, August, and September, Chinese investors sold a net $47.2 billion in US equities. This marks the largest quarterly sell-off by Chinese nationals since we began tracking this data in 1998. Here's where it gets interesting. That $47 billion didn't simply vanish. It was redirected somewhere specific. According to the World Gold Council's latest report, Chinese gold purchases in Q3 2025 broke down as follows. Individual investors bought $28.3 billion in physical gold bars and coins. Institutional buyers purchased $12.6 billion in gold ETFs and allocated gold. And family offices moved $6.3 billion into private vault storage. When you add it all up, it totals $47.2 billion, almost dollar for dollar. These investors sold American stocks and invested in gold. This isn't simply retail investors in Beijing, buying a few coins for their safes. It's China's wealthiest families, the billionaire class, making coordinated moves. For instance, Pony Ma, the founder of Tencent, reduced his US holdings by 40% and acquired $2.1 billion in gold. Jack Ma, Alibaba's founder, sold his remaining shares in Amazon and Meta and allocated $890 million to gold. Wang Jianlin of Dalian Wanda liquidated his entire US portfolio and directed $1.7 billion into gold. These actions are not driven by panicky retail traders. These are some of the most sophisticated investors on the planet, individuals with access to information beyond what the average person sees. They are decisively moving out of American stocks and into the oldest safe haven in human history. To understand why this shift is significant, it's essential to consider what Chinese billionaires were doing just 12 months ago. In Q3 2024, Chinese investors were net buyers of US stocks, adding $23 billion to their American equity positions. However, just a year later, this trend reversed dramatically, shifting from a positive $23 billion to a negative $47 billion. This represents a stunning $70 billion swing in sentiment within just 12 months, an unprecedented change considering that for the past 40 years, Chinese investors have primarily been accumulating US assets since Deng Xiaoping opened China's economy in 1978. The flow of Chinese capital into the US has predominantly been one way. Even during crises, such as the dot-com crash, the 2008 financial crisis, and the COVID-19 pandemic, Chinese investors continued to buy US assets, viewing these downturns as buying opportunities. However, this is no longer the case. Q3 2025 marks the first sustained reversal of this 40-year trend. Chinese investors are not just reducing their exposure, they are exiting entirely and shifting their investments to gold. When seasoned investors who have been buying US assets for 4 decades suddenly change course and flee, it indicates a serious problem. Not a trading opportunity, but a 5-alarm fire. To illustrate this point, let's go back to 2007, a time when the US housing market was at its peak. Banks, homeowners, and investors all believed that real estate could only appreciate in value. Subprime mortgages were being packaged into AAA-rated securities and sold to pension funds. The S&P 500 reached an all-time high of 1,565 in October 2007, and everything seemed perfect. Except for one significant detail. Chinese investors were quietly selling. According to Treasury Department data, Chinese investors sold a net $31 billion in U.S. equities between Q4 2006 and Q2 2007. At that time, the Western financial media barely noticed. CNBC did not cover it, and Bloomberg mentioned it only once in a footnote. Wall Street analysts dismissed it as mere portfolio rebalancing and said there was nothing to worry about. But soon after, the consequences of this oversight became evident. The timeline is alarming. In Q4 2006, Chinese selling began, with $8.2 billion in assets sold. By the first quarter of 2007, the selling accelerated to $12.5 billion. In the second quarter of 2007, peak selling occurred, with $10.8 billion sold. In June 2007, Bear Stearns hedge funds collapsed, and by August 2007, credit markets froze. The S&P 500 peaked at 1,565 in October 2007. In March 2008, Bear Stearns was acquired for a fraction of its value, and by September 2008, Lehman Brothers declared bankruptcy. The S&P 500 hit its lowest point at 666 in March 2009, a 57% decline from its peak. From the start of Chinese selling to the market crash bottom, 28 months had passed, less than 2.5 years. Here's a question that went unasked in 2007. How did Chinese investors know to sell US assets 12 to 18 months before the crash? The answer is straightforward. They had access to information that Western retail investors did not. Chinese billionaires benefit from three major sources of information that give them a significant edge. First, there's manufacturing data, real-time economic intelligence. China produces nearly everything consumed in the US. When retailers like Walmart, Target, and Amazon began cutting orders for Christmas 2007, Chinese factory owners were aware of the slowdown almost immediately, about 6 months before these changes appeared in US retail sales data, or GDP reports. They noticed the deceleration in Q4 2006, which is when the selling began. Second, there are banking relationships that provide inside information. Chinese banks were counterparties to American investment banks dealing with subprime mortgage securities. As a result, they were able to see the deteriorating quality of loans firsthand in 2006, recognizing that the AAA ratings were fraudulent because they were on the other side of these trades. While American pension funds were investing in subprime CDOS, Chinese banks were quietly reducing their exposure and warning wealthy clients. The Chinese government operates one of the most sophisticated intelligence gathering systems in the world. They monitor capital flows, trade data, satellite imagery of US ports and warehouses, and credit card transaction data. They recognize that the US housing bubble was about to burst because their intelligence apparatus provided real-time data, unlike the lagging indicators that US investors typically rely on. When Chinese billionaires started selling in late 2006, they were not making guesses. They knew what was coming. Fast forward to 2025. Chinese billionaires sold $47 billion in US equities in the third quarter. This figure is actually larger than the amount sold in 2007 when adjusted for inflation. $31 billion in 2007 is roughly equivalent to $45 billion in 2025. They are selling more now than they did before the most significant financial crisis since the Great Depression. If the trend continues, and historical patterns suggest that it will, American investors may have 12 to 18 months before a major market collapse, likely between the first and third quarters of 2026. This aligns with predictions I've been making on this channel. So why are they selling now? What do they see that American investors are overlooking? Chinese manufacturers are at the forefront of the AI infrastructure build-out. They produce servers, chips, cooling systems, and power supplies, and they are witnessing something alarming. Orders for AI-related chips are slowing down. According to data from the China Semiconductor Industry Association, orders in Q3 2025 fell by 22% compared to Q2. This marks the first quarterly decline since the launch of ChatGPT in late 2022. It's important to note that Chinese manufacturers typically detect demand changes 6 to 9 months before these changes impact corporate earnings. When companies like Nvidia, AMD, Microsoft, and Amazon reduce their chip orders in Q3 2025, Chinese factories feel the effects immediately. However, American investors won't notice this trend until Q4 earnings are reported in January 2026, by which time it may be too late. Chinese billionaires who own these factories receive real-time intelligence about the slowing AI spending. They aren't relying solely on analyst reports or CNBC. They hear directly from their factory managers that orders are being cancelled by major clients. This immediate feedback is why they are selling stocks of Nvidia, Microsoft, Amazon, and Google. They are aware that the AI revenue growth narrative is about to falter. Moreover, Chinese investors are well acquainted with sovereign debt crises. They have studied the collapse of the Japanese bubble in 1989, the Asian financial crisis in 1997, and the European debt crisis in 2011. Currently, they are observing similar warning signs in US debt levels. As of November 2025, the US national debt is $35.7 trillion, while the GDP is $27.4 trillion, resulting in a debt-to-GDP ratio of 130%. For context, Japan's debt crisis began when its debt-to-GDP ratio reached 120%, and Greece faced its collapse at 180%. With the US currently at 130% and the situation worsening, the potential for a crisis is evident. Chinese investors are increasingly concerned about the trajectory of the US government, believing it mirrors historical debt crises they've studied, with the US national debt reaching a staggering $35.7 trillion as of November 2025, and the debt-to-GDP ratio soaring to 130%. Many are questioning the stability of the dollar. The alarming financial history of Japan and Greece serves as a warning, as both countries face severe crises when their debt ratios approached and exceeded current US figures. Additionally, the approach the US has taken towards asset seizures has raised red flags among Chinese billionaires. The freezing of $300 billion in Russian assets and ongoing sanctions against Chinese companies have sparked fears that their own investments could be vulnerable. As a precaution, those holding significant wealth in American stocks, bonds, and real estate are looking to safeguard their assets. Many are opting to transfer their wealth into forms that are less susceptible to government intervention, such as physical gold stored in countries like Singapore, Hong Kong, or Switzerland. Moreover, the decline in the dollar's status as the world's primary reserve currency is another factor driving these investors' decisions. Since 2020, the dollar's share of global reserves has decreased from 62% to 58%. This shift represents a significant outflow of capital into other assets, particularly gold, which has seen central bank reserves increase by $2.3 trillion in the same period. Other currencies, like the yen and euro, are also gaining ground as alternatives. while the BRICS nations are actively working on establishing a trade system that operates outside the dominance of the dollar. This evolving landscape prompts Chinese billionaires to act quickly to protect their wealth from potential losses and instability. China is at the forefront of a significant shift in investment strategy, with Chinese billionaires taking proactive steps by investing in gold. They recognize 4 key systemic risks that are prompting them to sell off US stocks: the potential bursting of the AI bubble as factory orders slow, the unsustainable trajectory of US national debt, the risk of asset seizures due to geopolitical tensions, and the declining status of the dollar as the world's primary reserve currency. Their decision to divest isn't merely a reaction to poor performance in the market. It's a strategic move driven by deeper concerns about the overall stability of dollar-denominated assets. Gold, in particular, presents an appealing refuge for these investors, and there are specific reasons for this choice. First, gold possesses no counterparty risk, unlike stocks, where the value is contingent upon the performance of a company's management, economic conditions, and market stability. Physical gold stands alone. Its value has been recognized for millennia, independent of any corporate governance or economic situation. This intrinsic value means that gold remains unaffected by any potential mismanagement or market volatility. Second, gold is globally accepted. This portability offers a significant advantage over financial assets held in the US. If the US government were to seize Chinese-owned stocks, those investments could be lost indefinitely. However, gold stored in secure locations like Singapore remains accessible and protected from such actions, allowing for greater liquidity and security. Lastly, gold serves as a proven hedge against inflation. Historically, it has maintained its purchasing power through every major currency collapse, from the hyperinflation in Weimar Germany in 1923 to other crises throughout history. This characteristic makes gold an attractive asset in times of uncertainty, reinforcing the reasons behind the current trend of Chinese billionaires moving their wealth into gold before the broader market catches on to the looming risk associated with the dollar's dominance. During times of economic turmoil, gold has historically proven to be a safe haven for investors. Examples from recent history illustrate how gold holders have managed to preserve their capital amid significant currency devaluations and crises. In Zimbabwe in 2008, Venezuela from 2016 to 2020, and Argentina in 2001, those who held gold found a reliable means of safeguarding their wealth. With the current US national debt standing at $35.7 trillion and climbing, Chinese billionaires are making strategic decisions to prepare for potential dollar devaluation, with gold as their safeguard. Examining gold's performance during previous crises reveals a consistent pattern. Take the 2008 financial crisis, for instance. In March 2008, gold was priced at $920 per ounce, remaining relatively stable through the market crash. By September 2011, as the S&P 500 had fallen by 57% and took 4 years to recover, gold surged to $1,895, an impressive increase of 106%. In the COVID crash of 2020, gold began at $1,580 in January and ended up at $2,075 by August, while stocks plummeted 35% during the same period. Again, gold not only protected wealth, but thrived as markets began their recovery. If this historical trend continues, expectations for gold in 2025 to 2026 are optimistic. With current prices around $2,650, it's projected that by the first quarter of 2026, when the next market downturn begins, gold could rise to between $2,800 and $2,900, an increase of 8 to 10%. As the downturn hits its lowest point in the third quarter of 2026, prices may escalate to between $3,200 and $3,500, an increase of 25 to 35%. During the subsequent recovery from 2027 to 2028, gold could reach between $4,000 and $4,500, marking a significant appreciation of 50 to 70%. What sets the coming years apart from previous cycles is the current buying spree by central banks around the globe. In the third quarter of 2025 alone, central banks purchased 337 tons of gold, the highest demand since 2022. Notably, China's central bank added 78 tons, with substantial contributions from India, Poland, and Singapore. This trend of diversifying away from dollar reserves into gold creates a structural support underpinning gold prices that was not present in prior economic downturns, adding further bullish sentiment towards gold as a reliable store of value in uncertain times. Therefore, the proactive moves by Chinese billionaires reflect a belief in gold's pivotal role in navigating the challenges ahead. The dynamics of the gold market are influenced not just by demand, but also by supply constraints. For the past 5 years, gold mine production has remained flat, with no significant new discoveries of large deposits and existing mines nearing maturity. At the same time, demand is on the rise, driven by central banks, Chinese billionaires, Indian households, and eventually Western investors. This disparity of flat supply and surging demand sets the stage for rising prices. It's basic economics. An essential aspect that many investors overlook is the nature of capital flight, which doesn't occur all at once but rather unfolds in 3 distinct waves. Currently, we are experiencing Wave 1, characterized by smart money, billionaires, sovereign wealth funds, and family offices quietly selling US stocks and accumulating gold. This transition is estimated to involve between $50 billion and $100 billion by Q4 2025, with minimal market impact. These savvy investors are strategically divesting from their positions to avoid triggering a market panic, thus gradually exerting gentle downward pressure on stock valuations without crashing the market. Wave 2, expected from Q2 to Q3 2026, will involve institutional investors, hedge funds, pension funds, and mutual funds, forced to sell as the market begins to decline. This wave could see an outflow of between $500 billion and $1 trillion, and the market impact will be substantial. As retail investors notice stocks falling, they may redeem their mutual fund shares, forcing funds to sell stocks to generate cash. This selling can catalyze a downward spiral, creating further losses and leading to more redemptions. The pattern observed during the 2008 financial crisis Wave 3 is the retail panic phase, anticipated in Q4 2026 to Q1 2027, where retail investors, particularly 401k holders, begin to panic and sell at the market's bottom. This may result in a staggering $2 trillion to $3 trillion in selling pressure, contributing to the final capitulation. Unfortunately, by the time retail investors realize the extent of the situation and act, the market may have already hit its low point, marking the saddest phase of the cycle. During these unfolding events, gold is expected to shine particularly brightly. As institutional investors rotate towards safer assets, the demand for gold will likely soar, driven by the anxiety surrounding the stock market and increasing uncertainty. Those who have moved into gold early may stand to benefit significantly from this transition as Wave 2 and Wave 3 play out. This strategic positioning by early investors is crucial in navigating the upcoming market volatility. As we navigate the early stages of Wave 1 in this economic cycle, it's becoming increasingly clear that investors who wait too long to reposition themselves may face significant disadvantages. Chinese billionaires are stealthily exiting their positions while prominent investors like Warren Buffett are sitting on $334 billion in cash, and Michael Burry has amassed $1.1 billion in put options. The wise money is already aligned with the impending market shifts. If you act now, you can sell US stocks at current prices before the crash begins and buy gold at around $2,650 before it potentially rises to $3,500 or more. Avoiding the institutional panic of Wave 2 and the retail capitulation of Wave 3 is crucial. If you wait until those later phases, you risk selling stocks at lower prices and buying gold at elevated prices. An all-too-familiar cycle for many retail investors. To make the most of this critical period, it's essential to take action. Here are some steps to consider. 1. Assess your exposure. Take stock of how much of your portfolio is currently allocated to US stocks. This includes not only individual stocks but also index funds like the S&P 500 or NASDAQ, along with mutual funds and your 401k equity allocations. If your exposure exceeds 50% in US equities, you may be overexposed. Chinese billionaires are dramatically reducing their allocations from 60% to zero. While you don't need to eliminate your exposure completely, aiming to reduce it to 30 to 40% would be wise. 2. Build a gold position. Consider allocating 15% to 25% of your portfolio to gold. You have several options for gaining exposure. Option A. Physical gold. Purchasing gold bars or coins from reputable dealers could be a solid choice. The benefits include no counterparty risk and physical ownership, which cannot be hacked or frozen. However, there are challenges regarding storage and security, and premiums can be higher than spot prices. If you can manage safe storage, starting with 10 to 15% in physical gold is recommended. Option B. Gold ETFs. Exchange-traded funds like GLD or IAU in the US, or equivalent funds available in other countries, offer a more liquid way to invest in gold. They are easy to buy and sell, with storage handled by custodians, and no direct premiums over spot. However, be aware that you face counterparty risks, as you do not own the physical metal, and management fees may apply. Gold ETFs can be a good option for retirement accounts where physical gold investment is not practical. Taking these proactive steps can help you position yourself favorably for the upcoming market changes. The window to act responsibly and avoid being caught in the panic-selling phases is indeed closing. As you consider your investment strategy, here's a breakdown of some options. 1. Allocate to gold ETFs. Consider putting 10% to 20% of your portfolio into gold ETFs too. Option C. Gold mining stocks. You might also explore investing in gold mining stocks such as Newmont, Barrick Gold, or Franco-Nevada. Pros. These stocks can provide leverage to the gold price, potentially outperforming gold itself and also paying dividends. They're easier to buy and sell compared to physical gold. Cons. However, they come with company-specific risks and can be more volatile than physical gold. Since they are still stocks, they may fall in a market crash. Therefore, it's advisable to limit this allocation to about 3% to 5% as a speculative position rather than a core safe haven. A recommended allocation might look like this. If you have a $100,000 portfolio, aim for 20% in gold, which equals $20,000. You could consider $12,000 in physical gold bars or similar, $6,000 in a gold ETF like GLD or IIU, and $2,000 in gold mining stocks for that additional upside potential. 3. Reduce overvalued tech. Now is the time to reduce or eliminate positions in overvalued tech stocks. Notably, companies like Nvidia, which has a PE ratio of 60, and Palantir, with a staggering PE of 300, are on shaky ground. These valuations don't reflect profitability and are primarily driven by hype. Chinese billionaires are unloading these types of stocks. You should consider doing the same. However, consider retaining more stable stocks like Microsoft and Google, which are profitable, diversified, and have reasonable valuations. You can keep index funds, but it may be wise to reduce your allocation to around 30% to 40%. 4. Increase cash holdings. Aim for a cash allocation of 20% to 30%. This cash reserve has dual purposes. It provides safety during potential market downturns, allowing you to sleep well at night, and gives you buying power when stocks drop significantly, potentially 40% cheaper. During the crash, Chinese billionaires are shifting from stocks to cash and gold. You should also consider this strategy. 5. Set your timeline based on historical parallels. To navigate the unfolding events more strategically, align your timeline with historical precedents, such as the market activities leading up to the 2007 financial crisis. As we approach Q4 2025, keep in mind that Wave 1 continues, with smart money exiting positions. By following these strategies, you can better prepare yourself for the challenges ahead while positioning your portfolio to capitalize on emerging opportunities. Adjusting your exposure now could prove vital in navigating the forthcoming market volatility. As we look ahead, the forecast for the market is increasingly concerning. Here's a likely timeline to keep in mind. Q1 2026 is expected to see the market top out before initial cracks start to appear. By Q2 2026, the crash begins, marking the onset of Wave 2. This will likely lead to panic and capitulation in Q3 2026, which corresponds to Wave 3. As we reach Q4 2026, we could see a bottom formation, followed by a recovery phase from 2027 to 2028. This means you have a window of just 3 to 6 months to reposition your portfolio, not years. So don't delay. Here's a recommended portfolio allocation for the next 2 to 3 years to help you navigate these turbulent times. 30% in quality stocks. Focus on established companies like Microsoft and Google, as well as defensive stocks that tend to hold up during downturns. 25% in gold. Split between physical gold and gold ETFs to provide a hedge against market volatility. 25% in cash. Maintain this dry powder for making purchases when prices drop. 15% in bonds. Allocate funds to bonds for added safety and stability. 5% in gold miners. This offers potential upside for speculative gains, though it should be a minor portion of your portfolio. This strategic portfolio is designed to survive the impending crash with gold, cash, and bonds offering protection, while still participating in any remaining stock market upside. By maintaining this cash reserve, you'll position yourself to capitalize on buying opportunities when the market hits its bottom. Chinese billionaires are taking an even more defensive stance, opting for 0% in stocks. While you don't need to go to that extreme as an American investor, intelligently reducing your risk is crucial. Here's the context for these actions. In Q3 2025, Chinese billionaires moved a staggering $47 billion out of US stocks and into gold, the largest capital flight since 2007. Historically, the last time such a massive shift occurred, the S&P 500 dropped by 57% over the following 18 months. This shift now is driven by their insights into several troubling trends. The impending AI bubble burst due to declining factory orders, an unsustainable $35.7 trillion US debt crisis, risks associated with geopolitical tensions and asset seizures, and the dollar's declining status as the reserve currency. These wealthy, sophisticated investors have access to real-time data and insights, knowledge that ordinary investors typically lack. They're aware of the conditions on factory floors in Shenzhen and the intelligence landscape in Beijing, prompting them to seek safer havens. Historically, we've seen this pattern before. In 1929, Jesse Livermore forecasted the crash and profited by buying gold. In 2000, Julian Robertson wisely exited tech stocks before the dot-com collapse. In 2007, Chinese investors fled US assets and avoided the financial crisis. So, in 2025, Chinese billionaires are making similar moves. Time and again, the smart money has anticipated market shifts, while retail investors often ignore these warning signs, resulting in substantial losses. The choice is yours. Do you choose to follow the lead of those who understand the nuances of the market, or will you risk being swept up in the panic when it inevitably arrives? The time to act is growing shorter, so it's crucial to carefully consider your path forward. Choice A. Ignore the warning signs and believe that this time it's different. You might think the market only goes up and that you can always sell when it starts falling. This mentality was prevalent among retail investors in 1929, 2000, and 2007, and it didn't end well for them. Choice. Pay attention to what the smart money is signaling and take action. Start reducing your stock exposure, invest in gold, and build cash reserves. Position yourself to survive the upcoming crash and be ready to buy at the bottom. Chinese billionaires are making these moves right now, as is Warren Buffett with his $334 billion in cash and Michael Burry with $1.1 billion in put options. You have a window of 3 to 6 months to act, not 3 to 6 years. By Q2 2026, it will likely be too late. The crash will have begun, and you'll find stocks falling while gold may have already rallied 20 to 30%. If you wait, you risk selling low and buying high. By acting now, you can sell stocks at current prices. For example, consider buying gold at $2,650 before it rises to $3,500 and beyond. Build cash to have resources available during the downturn. This proactive approach allows you to retain peace of mind when others are in a panic. When the crash happens in 2026, you'll be well positioned. As the market begins to recover from 2027 to 2028, you'll have the chance to buy quality stocks at significantly discounted prices. Chinese billionaires have recently pulled $47 billion into gold for very good reasons. They're making informed decisions based on their insights and understanding of market dynamics. They weren't wrong in 2007, and they likely won't be wrong now. The pressing question is whether you will heed the warnings this time or become just another retail investor who learns the hard way that when the smart money starts to exit, it's a clear signal to reconsider your own positions. The cycle remains the same. Savvy investors identify unsustainable conditions, issue warnings about looming risks, and often find themselves overlooked by the broader crowd, only to be proven right when reality asserts itself. The insights from Michael Burry, who rightly predicted the 2008 crisis, are echoing again for 2026. The same applies to Chinese billionaires who successfully navigated the challenges of 2007. The real question for you is whether you will take this guidance seriously, or if you will join the ranks of those who realize too late the importance of following the indicators and insights from experienced investors. If you find this information valuable, consider subscribing for more insights and analysis.